Hi, this is Greg. In today's video, we're going to talk about the opportunity in today's real estate market. And if that's something you're interested in, you're in the right place because we're going to talk about a lot of great stuff here. So if you find value in this video, please hit the like button, hit the bell, make comments below. I appreciate your feedback, and the likes really help me out a lot with the channel. Okay? So I'm sure most of you are aware by now that the markets are in complete turmoil, and not only the stock markets and the financial markets, but the real estate market. Okay, I recently did a video called Real Estate Under Siege, which you can see. I'll put in the description below, and there will also be a reminder up here somewhere for you to take a look at during this video. But I talked about in that video really the downside of where we were in the market and some of the distress that we're seeing. In this video, we're going to talk about the upside and how people like you and me, people that are interested in investing in real estate, can take advantage of the current real estate market. Okay, so if that's of interest to you, let's get started. So anyone who knows anything about real estate knows that real estate is highly cyclical, which means that you have periods that are usually tied to interest rates and availability of capital that cause the market to gradually go up along with other asset values. And then something happens inevitably, right? Something happens and the money dries up, or the markets go in turmoil and real estate crashes. This crash presents an opportunity for real estate investors who want to get into the market, or for those who are already involved actively in real estate investing. The current market, as I've said before in previous videos, is in tremendous turmoil right now. The first was the COVID situation, and then most recently, as a result of that, there was a lot of financial dislocation in the capital markets, which put strain on lenders and reduced the availability of capital. Now, it's really the availability or lack of availability of capital which really gives real estate investors the opportunity, because when either spreads blow out and interest rates go up, it makes it more difficult for people to finance their properties. When it becomes more difficult or more expensive, property values come down. In addition to property values going down, it also makes it just more difficult for people to get loans, and so that lack of liquidity also affects asset values. Now, although typically these downturns are case by case according to regions of the country and according to markets, which are generally broken down into primary, secondary, and tertiary markets, generally divided by how large the metropolitan area is. In this particular situation here, post-COVID, I would say it's really affected all markets to a greater or lesser extent, but it's really affected all markets, particularly the large urban areas. Another important thing to focus on is, in addition to the financing environment, in addition to the sort of macro situation, different asset classes of real estate have been affected to a greater or lesser extent. As a result, there are clearly some asset classes which I would recommend staying away from, and some of these trends are, just continuing from the pre-COVID era, but have just been made worse after the COVID situation came in. So the asset classes that I would stay away from are basically suburban office. Okay, this was a very soft asset class even before the COVID thing. Retail. Okay, retail has, as I said on my previous video, has been suffering for a very long time. And the COVID situation, shutting down the smaller tenants and even putting pressure on many of the larger tenants, as you've seen with many of the retail bankruptcies recently, has just put tremendous pressure on retail. Also, another asset class that I would stay away from, whether you're an experienced investor or an unexperienced investor, is hospitality. I mean, hospitality an expertise unto itself. It's more like running a business, I believe, and less like real estate. As you probably know, that's been tremendously hit recently, but I would stay away from it because I think long term it's going to be a very difficult asset class unless you really know what you're doing and really just specialize in hospitality. So let's get to the fun part. Let's talk about the favorite asset classes and where I really see the opportunities, okay? As you might imagine, multifamily has held up as one of the best asset classes in this recent downturn. Okay, this is pretty obvious. People need a place to live, and as a result, they tend to pay their lease to, for their apartment or wherever they live. They tend to pay that first. That's one of the first things they pay. Another asset class that I particularly like and I think has a long-term viability going forward is self-storage. Okay, self-storage has gotten a little bit overbuilt, a little bit overdone in the recent run-up, but I still think that with people scaling down and with whether you're in a strong economy or a weak economy, self-storage, unless it gets overbuilt, that's what you got to pay attention to. I think that will be a good long-term bet going forward. Another favorite asset class that has also been favored for quite some time, certainly pre-COVID, since the last downturn, has been industrial. Okay, now the reason industrial / warehouse space strong going forward is lack of supply, which has been sort of uniform over the last several years, and also the fact that because of the trend to online commerce, there is an increasing demand in virtually all markets for warehouse space. So, because it goes hand in hand with the internet marketing of products and the e-commerce. Amazon and other companies like it are just taking a larger and larger percentage of commerce in this country, and sort of what's hurt brick and mortar retail is really helping the online commerce space and causing tremendous demand for warehouse space. Now, the last asset class, which I think is currently in a bit of a downturn, but I think long term is going to be okay, is urban office. And of course, this depends on which urban area you're talking about. But take New York, for example. I think that I feel pretty confident that urban office is going to do well once things stabilize and once things come back. A lot of people are talking about, places like New York, San Francisco, they're dead, they're dying, people are moving out. That may be true and that may be a short-term trend, but I think long-term, the demand for office space in urban areas is going to remain strong. Okay, so now that we talked about the asset classes, let's talk a little bit about financing. Okay, one thing to understand about real estate, particularly commercial real estate, is that it is a cash flow business, and as such is very dependent on financing. Not only the availability of financing, but the cost of financing. Okay, as either the availability of financing rises or lowers, or the rate of interest rates rise or lower, that determines to a very great extent the price of real estate. Along with that, currently there's been a tremendous amount of volatility in the markets, and spreads have blown out, which means that interest rates have risen. Even though the treasury markets have gone down, the spreads have widened from treasuries, resulting in higher interest rates. So as a result, the prices of real estate have to come down. Not only have the interest rates changed, but also the availability of capital has changed. Many lenders are not lending now, and those that are have increased the rate at which they will lend at. All of this results in reduction in asset values. So one of the critical issues to look at as you're looking out and you're seeing these opportunities and you're seeing that the market is getting soft or softer, and you're seeing some opportunities out there to get some great deals. How do you get started? How do you set yourself up, and how do you put yourself in a position to be able to access these opportunities? As I've stated before, I've been involved for a long time in the real estate market, both as an investor and as a financier. And in my mind, there's basically three ways that you can set yourself up for success in commercial real estate. Okay, one is as what I would call a sole practitioner. Okay, now when I think of a sole practitioner, what I mean is somebody who provides the money, provides the equity capital to purchase the property and improve the property. That same person, which would be you, would go out and obtain financing from a bank or a non-bank. And then whatever work or improvements were done on the property would also be done by you, okay? Or you would be the general contractor to improve the property. And you would also be in charge of the maintenance and the leasing. Okay, now this is a tremendous amount of work, but a lot of people go this route because they want the control and they feel that they have the talent and ability or experience to be able to do this wide range of things. It's not a bad way to start out, but everybody doesn't have the time to do this. You might have a full-time job, or you might have your own business or whatever, and you just want to expand into real estate sort of part-time and see how it goes. And eventually maybe you'll do it full-time, maybe you'll just do it as a side hustle. Incidentally, real estate is an excellent side hustle. That's the way I got into it when I worked on Wall Street many years ago. I was working on Wall Street, I was making a lot of money, and I had a partner who was in construction, and he would basically find the deals, he would do all the construction work, he would coordinate all the construction work. He and his wife would handle the leasing and the leasing and management side of it, and I would do all the financing and basically put the money in. Okay, that's another model. You can go out and get a partner. If you're the working partner, the guy who can be the construction guy and the management guy, that's great. Then you need a financial partner. If you're a financial person, or if you're a person who has money and you can't do all those other things, then you get what's called an operating partner. Okay, and this kind of partnership, assuming you can get along with the person, which is always an unknown when you first get involved. Even if you know the person, you never really know them until you live with them, so to speak. But this is a great way to be able to invest your capital in real estate, get most of the upside, and partner up with somebody who can do the heavy lifting at the property. Now what you do is you arrange it so that you get a return on your money, and then there's some kind of a split on the upside between the guy who put in the sweat equity and the guy who's putting up the money. Okay, this is an excellent financial arrangement if you can find the right person. My first partnership with this other individual was very successful. We did smaller properties in good locations in Bergen County, mostly in Bergen County, New Jersey, and I made money on virtually every single one of those deals, and that spanned from 1995 to 2005, which is when we basically sold the portfolio. Those people, many times their expertise is real estate. It's not really the financing side or the money side. So with my background and my expertise, I've been able to add a lot of value just on the money side, raising the money, putting the investors together, packaging up the deal, and basically bringing the equity capital to the table, and coordinating the bank or non-bank financing to bring the debt side to the table. And this can be also a very powerful way to do it, particularly when you're working the finance side and you are partnering up with a very good, very strong local operator. This is also the sort of business model that most institutions use when institutions invest in real estate. So that's pretty much what I wanted to cover in this video. I'm going to do videos after this which will basically touch upon exactly how you put these pieces together and exactly how you look at properties and exactly how you determine how a property should be priced and what the upside is on the property prior to purchasing it. I'll do some more videos in this series to go into that in more detail. So to summarize, the way to either get started or to continue as an experienced investor is to pick an asset class. You want to go with an asset class, obviously, that has a good long-term future. You want to understand the lending market, and you want to develop your lending relationships and really understand what's going on in the market, where debt is being priced, and at what leverage points, so you make the right purchasing decisions. You want to pick the best business model for your experience and expertise, and the way you can add the most value from your side and also get the most leverage from your partner or partner's side. And then most important, you want to take action. Okay? It's enough to study something, but I'm telling you, over the next year or two, there are going to be some very good opportunities out there. And if you ever thought that you wanted to get into real estate or you wanted to up your exposure to real estate, this is going to be an excellent time period to get started. So anyway, if you got value out of this, I would love you to hit the like button. It would really help me out. And hit the bells to be sure to be notified. And also, check out the description below. You'll see some valuable resources and comments, guys. I'm always interested in your comments. What did you like about this video? What would you like to hear more about? The channel here is about business, investment, and real estate, all in the context of the digital age. And we'll be coming forward with some more videos on this subject and other subjects very, very soon.